Welcome to our Affording College webinar. So let's get the scary stuff out of the way first. The numbers. Try not to get intimidated. These numbers are from the College Board for the year 2016 and 17. So clearly, these numbers can be pretty high, but what are your options? I want to talk about the various options and how to deal with them. We have paying out of pocket, scholarships and grants, student loans, and a combination of them all. Paying out of pocket may seem incredibly overwhelming and daunting, but for some, it may not be the worst choice. It depends on what you want. Most high school students aren't taught the value of budgeting and saving, so when it comes time for college, you might be on your own. You may have to go to school locally rather than far away, but hopefully you can live at home and save money. Statistics show it costs approximately $10,000 for housing alone. College classes are expensive, but sometimes the tax refund you can get can be huge. To give you an example, someone I know went to college and paid for 2 classes out of pocket to finish their degree. Paying for these 2 classes added over $2,000 to their tax refund the next year. Now, obviously, this is a specific situation, but if you're able to get scholarships and grants to help out, sometimes you can come out on top. For some, working while you go to school is a great option, and it can provide you with what? Work experience, which can be invaluable. Now let's talk about scholarships. So what exactly is a scholarship? A scholarship is a grant or payment made to support a student's education. They're usually awarded on achievement, academic, or sometimes need. Scholarships do not have to be paid back. You can apply for scholarships as early as freshman year of high school. If you win a scholarship before you know what school you'll go to, they will either write you a check if you promise to use it for school, or they'll just hold on to the money until you get accepted and know where you want to go. But the important thing to remember is don't wait until your college plans are finalized to apply for scholarships. And another big thing to remember is you should not have to pay any fees to apply for any scholarship. The scholarships are designed to help you. Many scholarships are renewable. That means if you win them for more than 1 year, if you meet certain requirements, of course. Sometimes these requirements are that you'll continue to go to the same school, you maintain a certain GPA, or you keep the same major. When you win a scholarship, ask the organization what you need to do to maintain your award. In most cases, you'll just need to basically keep up the status quo. One of the biggest mistakes that many students make is they stop applying for scholarships once they've graduated from high school. There are literally thousands of scholarships for students in college and even for graduate students. Some of these awards are only open to students who are already in college. Your financial aid officer and your major's department are 2 of the best sources for these kinds of awards. Essays can be a great way for scholarship judges to get to know you beyond your grades. But there are some scholarships that don't even require an essay, but these are usually for art, music, or other types of awards that require a portfolio or project instead. There are basically 2 types of scholarships: need-based and merit-based. As the name suggests, need-based scholarships are based on your financial needs and your parents' income. Merit-based scholarships are based on academic or extracurricular achievements. Your parents' income is usually not factored in for merit-based scholarships. A grant is a special kind of scholarship. A grant is usually needs-based, and it's typically for students who come from low-income families. Like a scholarship, a grant does not need to be paid back. For undergraduates, the most common grant is the Pell Grant. This will take into account your income and your parents' income. If you meet the criteria, you'll be eligible for assistance. Depending upon how many classes you take, you can get up to $5,700 a year from a Pell Grant. Any extra that does not need to go to tuition is yours to keep and can be used for books and related expenses. It's important to remember that you have to reapply for this grant every year. To get a grant, you'll have to use what is called the FAFSA. That's the free application for federal student aid. It's the application used by nearly all colleges and universities to determine eligibility for federal, state, and college-sponsored financial aid. These include grants, educational loans, and work-study programs. FAFSA should be your first step when you're applying for financial aid. In some cases, Pell Grants, given by the FAFSA, may be able to completely cover your education. For example, if you're going to a local college and you don't have to live on campus, the grants may be all you need. To be eligible to submit a FAFSA, you must meet the following criteria. You need to be a U.S. citizen, a U.S. national, or an eligible non-citizen, have a valid Social Security number, have a high school diploma or GED, be registered with the U.S. Selected Services if you're a male aged 18 to 25, complete a FAFSA promising to use any federal aid for educational purposes, and you must not owe refunds on any federal student grants. I strongly encourage all students to check with their school's financial aid office to determine their exact FAFSA deadline requirements and to file it as soon as possible after January 1st. Remember that when applying for scholarships, it's always free. We've seen many websites that offer to fill out forms for you. These sites sometimes charge as much as $80 to $100 for something you can do for yourself at no charge. Here are some common scholarship scams that I want you to look out for. Many scams encourage you to send them money up front, but provide little or nothing in exchange. Usually victims write off the expense, thinking that they simply did not win the scholarship. Next, there's a scam that looks just like a real scholarship program, but requires an application fee. The typical scam receives 5,000 to 10,000 applications and charges between $5 to $35. Scholarship scams like this can afford to pay out $1,000 for a scholarship or even $2,000, and they'll still pocket a hefty profit. And they might not even send a scholarship out at all, and your chances of winning it are likely less than winning the lottery. The advance fee scam offers you an unusually low interest rate loan and requires you pay a fee before you receive the loan. But then the promised loan never comes through. Legitimate loan providers deduct any fees from the check. They'll never require an upfront fee when you submit the application. If the loan is not issued by a bank or other recognized lender, it's probably a scam. Next, I want to mention the scholarship prize scam. This is where they tell you you've won a college scholarship worth thousands of dollars, but they require you to pay a disbursement or redemption fee, or even the taxes, before they can release the prize. If someone says you won a prize or a scholarship and you don't remember entering the contest or submitting any application, be suspicious. Student loans are offered to students to pay education-related expenses, such as tuition, room and board, or textbooks. Many of these loans are offered to students at lower interest rates. In general, students are not required to pay back these loans until the end of a grace period, which is usually 6 months after they graduate. Typically, when you complete your FAFSA, you are also offered student loans. Stafford loans are the most common type of federal loan. Money for these loans comes directly from the federal government in a program called the Federal Direct Student Loan Program. There are two types of Stafford loans, subsidized and unsubsidized. If your loan is subsidized, you won't have to make any payments until you graduate. Interest rates are typically at or below 6.8%, and the government will pay the interest while you're in school, so the interest won't build up while you're a student. Subsidized loans are reserved for students who demonstrate financial hardship. Most go to students whose families' annual incomes are below $50,000. If you have an unsubsidized loan, you're responsible for paying all of the interest. Interest builds up at the fixed rate of 6.8% while you're in school, but payments are typically deferred or postponed until after you graduate. All students are eligible for this type of a loan, so while you're a student, you're not responsible for the payments, but the amount you owe will continue to increase over time because the interest will keep adding up. Perkin loans are more desirable than Stafford loans, but they have more eligibility rules. Perkin loans have a fixed interest rate of 5%. They are all subsidized, so the government pays the interest while you're in school and even for a short time after you graduate. Perkins loans are reserved for students who show exceptional financial need. These loans are funded by the government but dispersed by each individual college or university. The federal government distributes a limited amount of funds to each school, and the school determines which students to give it to. PLUS loans are also available for both parents and graduate students. Parent PLUS loans are for parents of dependent undergraduate students, and the Grad PLUS loan are for graduate students themselves. Then we have private education loans, and this can be an option if other sources of financial aid do not cover the cost of school. These loans are provided by private lenders and do not use government funding. Private education loans are more like regular personal loans. Your eligibility and interest rate depend on your credit score. Interest rates are typically higher than federal guaranteed education loans, and borrowing terms vary by lender, so you must be diligent in understanding the terms so you don't end up with huge amounts of student debt after graduation. Remember, you're going to have to pay this money back. If you take more than you need, you're responsible for it. If you have unsubsidized loans, try to make payments towards the loan while you're still in school. The more you can pay now, the less interest will accumulate. Typically, you'll be offered both subsidized and unsubsidized loans. If you can get away with taking only out subsidized loans, do it. No interest builds up on these. Your loans are not due until 6 months after you graduate. So now let's talk about what you're not supposed to do with student loan money. Do not spend more than you need. If you take out money and you don't need it all, you can give back the excess. So if you take out $4,000 and you only end up needing $2,000, just send the difference back to the student loan lender. Do not take out student loans if you do not plan on finishing college. And never miss a payment on your student loans, or really any other loan for that matter. One mistake can haunt you up to 7 years. With an average student loan payment of approximately $351 and a payoff period of around 18 years, that means the average person will pay more than $43,000 towards their student loans. Now you may be asking, how does that make sense if the average loan amount is $28,000? Well, that's because approximately $15,000 of it goes to interest. Now this list is about the risks you run when taking out student loans. This is worst case scenario, but let's say that one day you are strapped with debt, tons of credit cards or medical bills, and you just can't get rid of it. Bankruptcy may allow you to wipe the slate clean, with some consequences. However, most student loans are not eligible in bankruptcy. You have to keep in mind that credit is important. Your credit is the profile that banks and lenders use to determine how reliable you are. It's also what landlords use to determine if they'll rent to you. And more than 50% of all employers use your credit to determine if they'll hire you. Some jobs will also pull your credit before even promoting you. Imagine this snowball effect. You take out student loans. You get a degree. The job market isn't hot for your degree right now. So you start making less than you're worth. You can't pay back your student loans. Now your credit is destroyed and you can't get housing or a better job. You know, this can be a real-life example of what can happen. But remember, if you're destined for college, keep your head up, be smart about your money, and do your best. Thank you for joining our webinar. We hope that you'll check out some of the other topics we cover as well.